All right, here's a scary thought. Imagine losing 6 billion in value overnight. This is exactly what happened to FedEx last week when they reported the earnings. In one single day, share price dropped by 13%, losing market cap of $6 billion. Now, what do we do? Dividend investors, bonjour. This is Mike Hiroux, founder of Dividend Stocks Rocks and passionate investor. Last week, I received an email from one of my DSR member, Ilem, asking me to review FedEx stock card. When I looked up at the website, I noticed that the stock card was dated in April. And as you know, we review our stock cards twice a year. So chances are we're going to review FedEx throughout the month of October and maybe November, depending on what's happening, right? But then I realized why she really wanted us to have a fresh look on the company. It's not because the stock card is really old, but rather because the day before she sent the email, FedEx was down 13%, losing $6 billion in cap value. That's crazy. That's huge. I mean, you have this kind of company in your portfolio, you open up your brokerage account this morning and you wonder what you should do, right? Because you're losing overnight 10% on your investment, and that hurts. And I can feel the panic, and I can feel why you don't like the stocks so much anymore, especially when you look at the overall trend for FedEx. It's been a while that the stock is just keep getting beaten up by the market, and now you're just wondering, oh, is this the final nail in the coffin? Should I get rid of it or not? And I'll tell you up front, I'm not going to review FedEx live in this video, but I'm going to attack a broader question. Should you follow your stock on a weekly or daily basis? And you probably know me by now. The answer is no. It's just like a big no. The reason why it's a no, it's because if you follow your stock on a weekly or a monthly or daily basis, you're just following the noise. And what you will realize if you look at any stock price graph is that it goes up and down all the time, and most of the time there's absolutely no reason. And we're going to look at why they are like intraday, or weekly volatility, and there are like basically three things affecting the stock price on a short-term basis. The first one is the overall, I would say, feeling about the market. So if the market is bullish or bearish, every week or so, the stock will go up or down following the theme of the day, right? The flavor of the day. So if the market they just love what's happening, they love because macroeconomics data is doing well, we have some earnings that are like pumping up the stocks and so on, we'll see stocks going up for absolutely no reason. And then you have the overall feeling in the specific industry. So if an industry is doing very well, then all the stocks, like a wave that is going up like this, everything is bringing back to the top by magic, and then FedEx would likely surf that wave. In this case, it's quite the opposite. The market is relatively bearish about global economy right now, and it's even more bearish about the distribution, transportation business like UPS and FedEx. First, there's a trade war, and then there's Amazon, with a threat of disrupting the whole thing. So the market isn't too keen on investing in FedEx right now or in UPS. And then you have the specific stocks. FedEx has posted inconsistent results over the past couple of years. Every quarter it's so-so. Sometimes it misses the earnings and the revenue expectations. Sometimes it meets it. So there's that uncertainty and lack of consistency that the market doesn't like. And for that reason, the stock is going slowly but surely on a downtrend. Now it brings us to the reason number 2 why your stock should either jump or go down by double digit on earnings day. It's basically missing or beating the hell out of the expectations. So every quarter, financial analysts, they got together, they talk, they go play golf with the CEO or whatever. And they're just issuing, I was like, you know what? I think FedEx is going to grow their business by 4% next quarter. And then earnings are going to jump by 10%. So what happens if you don't meet those expectations? Most of the time, some analysts will just drop the stock or revise the stock downward, and then you're going to lose a few bucks on the price share. In the terms of FedEx, it's pretty much what happened in the past couple of quarters where the company lacked of consistency. You will also see the opposite. I'm thinking of Hasbro, for example, that did a strong earning beats not too long ago, and then shares popped, I think, like 8% on earnings day. Does it really mean that the company worth 8% or 10% more overnight? No, it doesn't. That's just noise. And just to prove you, look at Hasbro stock price trend. And funny enough, about a few weeks after earnings release, they announced that they would disburse $3.3 billion or British pound, I think, to buy Peppa Pigs, right? And the market didn't like Peppa Pig that much, and the stock lost about 10% again. And now it jumped back gradually because the overall market likes Hasbro right now, and fear has been, taken aside. So basically, if you look at Hasbro going up and going down, you just have a big headache, but the price is not doing so bad or not doing so well. It's just going up and going down, so for no reason. And then the last reason why your stock will get a big hit or a big jump on earnings day is guidance. Guidance is like going to the movie and watching previews before the main presentation. So you watch the preview, and now you just say, oh, I really like that. I really want to go back to the movie theater and see that next movie in 3 months. I'm so excited about it. And sometimes the CEO did a very bad preview and now disappoint the market. And FedEx revised their guidance saying, we're not going to have a good 12 months in front of us. Trade war is waiting in, and the economy slowing down, and we have basically a bunch of headwinds that we're facing, a bunch of challenges, and we don't really look like what the next 12 months we're gonna bring on the table. And there you go, FedEx dropped 13% because of that. Is it justified? I think it's exaggerated, but it is. Most of the time, when you look at double-digit movement on a single day, it's just an aberration of the market. To me, that doesn't mean anything, and it doesn't mean that I should review my investment thesis either. And it would have been the same thing if FedEx yesterday would say, oh, we reviewed our guidance and we think that revenue and earnings are going to jump by 12% in the next 12 months because so many great things are happening. Well, then the market would have probably bumped up the stocks by a good chunk, and then all investors would feel that they're geniuses and to be happy. But then again, that's just short-term noise. What really matters, and I've repeated that in 2 of my past videos about losing or making money with your holdings, is just review your investment thesis. If the investment thesis around FedEx is still good today, what's going to happen in the next 12 months doesn't matter. Because as an investor, you should not invest for the next 12 months. You should invest for the next 12 years, or even more than that, for the next 20 years. So do you think that FedEx will do well for the next 12, 15, 20 years in front of you? And if the answer is yes, you don't have to wonder what's happening in the next 12 months. Investing is like running a marathon. You don't need to wonder what's happening on kilometer 6 or kilometer 8. That doesn't matter. You still have to run 42 kilometers. I mean, it's a lot of miles, a lot of kilometers to run, right? So what you want to really make sure is that your hydration level is good, your pace is good, and you're right on track within your strategy to run that marathon. You don't need to know, oh, there's a 1K uphill going in front of me, and this is going to be a very tough one. It's going to be a very tough 5 or 10 minutes ahead of me. Yes, those things are going to happen. You're going to face challenges during your marathon, but what really matters is the finish line. and with your investment is exactly the same thing. So we will keep continuing reviewing our stock cards every 6 months and not every quarter or even every month for that very same reason. We don't want to overload you with noise. We want to make sure that you have concise information that makes sense, that is totally on track with your investment strategy. So I hope that after viewing this video, you will not look at your stock, especially on the day of the earnings. And you know what? The best way to do it is just to give us the mandate of upgrading your account to DSR Pro. We're going to build a summary of all earnings report each quarter and send it to you. So then you can act on concise information and still focus on your straightforward process to invest your money. Then again, it was Mike Roux from Dividend Stocks Rocks, and until the next video, stay invested.